There you
Great.
go.
Thank you, Sean. Welcome, everyone. Thank you again for being with us on this beautiful hot Wednesday. Another class, and hopefully it's a timely one. Tonight, we are going to speak about my exiting rules. I thought it would be good to revisit that with the market volatilities, and this is opportune time to revisit our selling rules. When do we get out of our investments and our trades? What is the most efficient time? What is the most profitable time? Um, as you recall, in last few weeks, we started speaking about the trading plan, the business plan. We wanted to have a business model, why we are in this trading business. Then we followed up with the trading psychology, our emotional side of the investing. And after that, we talked about some hedging strategies, um, how to protect our profits. So with that, I think that was a good segue to tonight's class to speak about really when is a good time to get out of our investments. Because we do, um, well, first of all, I gotta do this disclosure, this is for educational intention only. There's no recommendation. Again, this is, we are not investment advisors. So anyway, that's one thing. So in 1980s, there was a study done with Stanford and a few other universities, and they found out that monkeys, by throwing darts at the piece of paper with the list of stocks, like Wall Street Journal, they actually beat professional money managers and portfolio managers. So there has been a lot of emphasis here about what to buy, and yet even randomly, if you bought something, you would have been profitable because about 80% of the time, majority of stocks do follow the markets as a whole. And believe it or not, when the markets actually drop, up to 95% of the stocks follow the market. So it's very important to understand the big picture and the major indexes while you investing in, especially choosing, in this case, let's say stocks. If you have other ones, they do follow the macro cap and the macro economy. So um, the problem we have is not much of a time is spent on when to exit your investments, whether you're profitable or not. And because of the excitement of getting in, it's almost going on a trip, but not knowing when to finish your trip. So I thought tonight would be a good idea to visit because these monkeys were really good at throwing the darts, but they never told us when they were throwing darts to get out of these stocks. So that's what is important to learn. So tonight, what I'm gonna talk about is a few issues, some of the criteria for um, your selling discipline, whether you're from fundamental point of view, technical point of view, emotional money management side of things. And then I like to finish it up with my 7 rules that I apply to my investments and my trading. So you can see, I've emphasized it before, we did have the trading psychology that it is so crucial to, again, look inner yourself and found out what is the reason you're in these investments or actually in this business. So it's a lot of self-analysis should be done. And I emphasize this, I think, on every class because it has been the secret of success for um, very successful hedge fund managers, traders, investors. And I like to really emphasize this. So that's what I want you to, before getting so much into the technical side of investing, really do again inner search. And the reason I use this is because we want to understand again, uh, when you get into an investment, do you have a clear mission? Do you have a vision why you're actually even investing and trading? So you have to know why you're in this business and why you bought, or if it's for your long-term investments, why you got in. Also, it's very important to understand your personality and biases. You've got to know, again, we talked about psychology. What kind of a person are you? Are you emotionally reactive? Are you methodical? You like to, are you perfectionist? You like to have the things in exactly the way you want. You have to do a lot of research and analysis, and whether you want to make sure you're correct all the time, or you have these gambling fallacies. You have this gambling mind that you like that excitement, you want to get in, and then, or also, are you a warrior? Do you feel that if you're in the stock, you lose sleeps, or any type of investments in currencies, commodities? You have to understand yourself. You have to also understand your money beliefs. You have to go search to see what is your relationship with money and where do you stand. So that helps you actually to find out when there's a good reason to get out. And we will talk about, for instance, for the losses, is this a reflection of a failure for you? And that's why you stick in a losing uh, trade or investments for a long time? Or are you business-like? It doesn't really matter. It's just, this is a part of business. So this is very important. The third thing is, and we've talked about this a lot before, is you have to differentiate whether you're a trader, you do the short term and you're a swing trader, you do it for weeks, a few weeks, for days, for hours, for minutes, or are you a long-term investor? And that makes a difference as far as the choice of your investment vehicles and also the choice of your exiting rules. So basically it's short-term versus long-term. Also, the vehicles of your investments that you choose, it dictates what would be the best exit strategy. Are you emphasizing more in stocks? Do you do futures? Do you do options, forex and currencies, real estate, bonds, Bitcoin, and on and on? So basically, you have to know which emphasis is done as far as the investment vehicles that you have chosen. At the end of the day, we go back to that trading um, uh, plans that we spoke about in the past. Do you have a good journal? Because with the journal, when you write down your reasons to get in, you also at the same time you put down the reasons you want to get out of this investment. What was the reasons you got in, and when things don't go the right way, what are the reasons to get out? And once you write these, it's important to abide by them and don't get emotional, don't change your plans, because once you get into in your trade or your investing, you end up sometimes becoming, a lot of negotiations goes on, a lot of excuses come in, a lot of praying comes in, and that's why it's good to have things before you getting the trade, so it's already set. You did not have any emotional attachments. There was no monetary attachment. So make sure these are done. These are simple things, but believe me, these go a long way. And once you make a habit of it, then it's really, we talked about in this trading psychology, you become intuitive and you can follow the rules a lot easier. So my simple rules are, whether, whatever vehicle I use, I want to know, why did I take this action? When, let's say, I chose something and I thought maybe it's a good investment and I want to get in. So I have to have my reason. I write it in my journal. And once I did that, let's say I'm positive about an agriculture or a precious metals. If I got my reasons, what action do I want to take? Now, do I want to be a buyer or do I want to sell against it? So these are the things that have to be very clear. And once I know about that and how do I want to take that action, what vehicles I'm going to use? Am I going to buy options on this? Do I do futures? Do I simply just buy the stock of this plan? So you really have to be very clear on that. And once everything is done, then when is a good time? At what price? So once you're clear about that, things really fall in places. And again, once you look at it as a business model, then it's a lot easier to get out of it, because you're looking at as actually, again, a business, not marriage. So it is important, again, I mentioned with the traders and investors, we have different strategies for, especially in the selling. So getting in is the same, you just say, oh, this is a great time. I did my research. I want to buy this futures, but getting out is a little different. So We've talked about this before, but I quickly go over some of the characteristics of, being a trader versus investor. So obviously, the time horizon, traders are more short term, investors are long term. The objective for traders are most of the time is income. So it is in this situation is more of a just having additional residual income. And for investors, like wealth creation, it's increasing your wealth. So that's why you have a long-term horizon. The risk profile with the traders, they're most of the time risk takers because they have to make quick decisions, are in and out. With investors, is they're risk averse. They do a lot more study, but once in there, because it's a long term, they like to protect their profits and they want to take less risk. Volatility, obviously traders like more volatility because it gives them the opportunities. When you're investors, you like to sleep at night and you don't want to worry about this fluctuations of the market. So you like the more stability and you like the stability. As far as analysis goes, traders look more into the technical side and they like to look at the charts, they look at the timing of things. With investors, because of the time that they have and long horizon, they take their time, they look at the fundamentals of the company or that investments and stick with it for a longer term. The personality for the traders are quick decisions. They have to make it snap of a finger. Sometimes they have to be on their toes all the time. Investors are more patient, again, because of the long-term horizon. Obviously, with stress level, when you're a quick decision, you're in and out, generally it's higher stress level. On the other hand, with investors, because you know for long term, you're going to be sitting on these investments, really these fluctuations, most of the time, and especially you're trending, it doesn't bother you as much. You're diversified enough and you think that, things will take care of them, the markets. So you are more patient. Now, the tolls paid to the markets, the education tuition is with traders is much higher because we make mistakes, we get in, we do psychological, emotional, even our systems, our strategies sometimes don't work, so we pay higher price. With investors, because it's a long term, obviously it is at least less obvious. Maybe in long term you get bad luck and you keep buying the wrong companies, you pay a much larger tuition. But in the long run, because you're not in and out of the markets, you basically pay a lot less. There used to be a lot of commissions. Traders had to pay, well, you now with no really low commissions, it's not a factor, but that was a factor for long-term investors. Information required. So for traders, we need the real-time news data immediately in our toes. We want to see what's happening to the markets. With investors, it's more of a fundamental ideas, things that they have studied and they feel comfortable because the time horizon is maybe 5, 10, 20 years. The short-term anomalies they do not bother them. So the information that required, it could be, again, they've done their research and analysis. So it doesn't have to be real time. They don't have to check the markets every second. They can do their whatever work they have so they can be, again, being patient. Now, types of investments for traders is the futures, options, forex, stocks, ETFs. You can do a lot of different varieties, bitcoins if you want, but which you can use futures for it. With the investors, usually it's more of a long term. You could still use long term like leaps in options, ETFs, stocks, but a lot of times it's in mutual funds, real estate. These are long term horizon. Bitcoin, again, it could be something that you can hold on for a long time. And that's why you can do, again, the fundamental analysis. But those are the tools that you can use. Now, the taxes for the traders could be of high or low, depending on vehicles you use. Because of, again, the trading, because the frequency, they're all short terms, under 12 months. So obviously, it's more of an ordinary income. On the other hand, if you do the futures trading, you have the 60-40 rule. That 60% of your trading profits is treated as a long-term capital gains, whether you run it in a second or 10 minutes or 10 days or 10 months. With investors, obviously, it's generally low because as long as the tax laws don't change, it's more of if it's over 12 months on one day, then you have this long-term capital gains, which is usually lower depending on your income tax bracket. So there are different reasons when you got into the investment. So I'm going to go to different criteria why you got into the investments, and we review based on that why you should get out of these investments basis. So if your reasoning to buy the investment vehicle was for fundamental analysis reasons, which is, basically use the valuations, look at the price earnings, you look at the price to book, price to sales, and then you got in after you review, let's say after earnings, and when you look at fundamentally periodically when you check it, if you see that the trade rating fundamentals, let's say um, the company is thinking of cutting the dividends, the earning outlook is not as positive, the sales outlook doesn't look good, there's a huge increase in debt to equity, the return on equity getting lower and lower, the profitability is going lower. There's a lot of things fundamentally is going wrong with this, especially we look back in the last 6 months, 8 months, we look at the energy sector, we look at the oil companies, and we look at what is happening. So that's the valuation, that's the fundamental, the companies are not doing as well. So this is the time you have to review, are you going to still be in this investments, or would that be a better time to move on because you have the opportunity cost, because the money, your capital is tied in this investments, maybe you could find some other opportunities. So basically that's the fundamental reason you're in this investment. Now talking about fundamentals, again, there's a two major analysis. There's a technical analysis that we look at the charts, we look at the indicators and let's say moving averages and the graphs. Again, it's more of a short term, it's more of a visual, don't usually do much with the fundamental side of things. On the other hand, fundamental analysis is more of a, you actually sit down, you look at the macro, and then you look at the company, and you look at what is the outlook for the futures, how's the industry doing, what is the economic conditions, how it's going to happen with their sales, and what is happening to the balance sheet, the income statement. So you look at all that, and that's again because we do a lot of these research, and that's why you have financial analysts look at these things. So you look at the research analysts. So that's being fundamental analysis. That becomes more long term. So the technical analysis is used more by the traders. They're short term. They use it for trading. They look at the charts. They look at price and volume. On the other hand, the fundamental analyst looks at, or usually they're investors, look at the long term, they look at the financial statements, and they look at the quantitative, looking at the numbers, but also qualitative factors. They look at the managements, things that beyond the papers. They see how this company is run. What is the board of directors? They look at the compliance side of things. They look at how this is run. Is the CEO the same as the president? How much of the power the CFO has? Do they have the outside, for instance, board members, and especially in auditing? So basically, that's the fundamental side of things. So a technical, analyst couldn't care less about the board. They could not. A lot of times when a lot of investors now they kind of mix these together. So a lot of mutual fund managers, for instance, they still look at charts. They do follow moving averages. So, and it has become important for them to, with again, the power of algos and program trading, that obviously technical analysis has played a bigger role. So there is this marriage between these two. So it's not purely one or the other. But if it is a short-term trading, especially like the futures, obviously you're more into technical side of things. So how does the technical analysis of the stocks work? What do we look at is some of the criteria it's used is like the moving averages, which is, as you know, I use that a lot. We look at the support and resistance, the trend lines. We look at the Fibonacci's. We look at the Gann and Elliott waves, which are pretty subjective. And then we look at the classical technical analysis, double top. We have the head and shoulders, the channels, the triangles, the wedges, the flags, the pennants. And then we look at lately Ichimoku's finding a lot of popularity, which is more of a future prediction in some ways. It looks at the future. So Ichimoku is attractive. So these are some of the tools that you could use for um, getting in and out of um, investments or your trading using these tools. On top of that, there's the technical indicators that you could use, the stochastics, the RSI, the relative strength index, the MACD, the moving averages, convergence, divergence. You could use VWAP, which is the volume weighted average price, which is based on where the most volume is happening, to put more value on that. So you can use that as a selling point when the drops, when it's way higher than what it should be on the average. That's when you get out. You look at the money flow, you look at the Bollinger Bands and Keltner channels. So all of these are the criteria. So if your criteria was getting in based on any of these indicators, let's say it was oversold on the top three, if or the VWAP was really underpriced, money flow is getting stronger, you got in. Bollinger Bands, you're in the lower band, or maybe it's a strengthening it. There was a squeeze and you're getting, there's a strength, so you want to ride the trend. Keltner channel is the same thing. Then the opposite should apply. So if it's you're using the same technical indicators, this is the time when the stochastics have gone embedded and then they were overbought and coming down. If that was your reason, then that's the time to get out. So these are the technical side of things. The third criteria, besides the fundamental analysis from technical analysis, is money management. So you could have a fixed criteria in your mind from money management point of view. For instance, you decide and say that, if my investment goes down 5%, 10%, 15%, I'm out of it, period. I can sleep better at nights because I know, okay, this plan didn't work out and I can jump into another opportunity. For instance, Investor Business Daily uses, like Bill O'Neill, he uses 8%. So you can choose your comfort number. You can say, well, I don't want to risk more than 2% of my total capital in one investment, for instance. You can use that as a criteria. Or you could have a profit target. You say, okay, I bought it at this price. If it goes up 20%, 30%, 50%, I am very happy with that. So that should be your other criteria from the profit target point of view. You could also use the average true range, which is the ATR, which you have access to it to any platform on Finviz, which is usually the past 14 days. And it just looks at, in the past 14 days, what was the daily average price of this investment. So let's say if it's a $10 stock, I just use that as if it was up $1 up or $1 down, then you can use that and say, well, I know this ATR is like $1. So if it goes more than two, so you double it, you could have 1.5, 2, 3. It's up to you. But it is mathematically oriented. So you can say, well, more than that, if it goes up, I'm fine with that. I think it's kind of rubber band is being stretched. So I want to be out of that. If it goes down one ATR or two ATRs, I'm out of it. That means there's a little, there's a selling pressure, maybe it's coming in. The same thing we've talked about expected move. We've talked about the standard deviations. So these are the things that you could use as a criteria to, if it moves out of that range, whether you're using two standard deviation or on the expected move, you use one standard deviation, then this will help you to have, again, that peace of mind, that knowing that, okay, this was my system, I wrote it down and I'm out of it. The other thing is you could also use some of the profit targets based on your fundamental analysis. You looked at the discounted cash value. Let's say you're a value investor. You look at the dividend model. You look at some of the analyst targets, some of well-respected analysts, and you said, based on that, for instance, this company was valued at this. If it hits that target, you have to reevaluate and say, well, this is a good time maybe to get out. The discounted cash flow, maybe you use that to get into a nice valuation. It was a solid company. Now it's getting really rich. So that would be something from, again, from the valuation point of view, might not be a bad idea to reevaluate. Don't have to get out of the whole thing. Maybe lighten up. Again, there is no bad money when there's no bad profit. So it's always nice to have some profit. It just gives you more flexibility to become, as far as managing your risk. The other ideas, as far as the money management goes, is it could be beyond your control. These are the things that you, tough times happen, you need cash. At that time, when you need cash, then the fundamental analysis or technical analysis out the door. This is based on need. So because it's based on need, well, that's another rule that, well, this is a time you find what is like the, either you've had the best opportunity, you think you've hit the target, you want to get out, or it is based on need. Now, one thing Warren Buffett also emphasizes is like, don't ever have a panic sale. So that's the worst kind. In this case, if you need cash, though, on the other hand, well, you need cash. You want to get out. And I always use this example of, this doesn't just apply to individuals, it applies to companies, it applies to municipalities and the countries. When you go back to 2010, 2011, when we had pigs, when you had Portugal, when you had Italy and Ireland, and you had Greece and Spain, at that time there was just so much, as far as need goes, the urgency was that a lot of central banks, they were selling their gold. And you would think, because of the panic, the money usually goes to the most conservative and risk averse investment at that time as insurance, which would be gold. But the gold was actually going down. The reason was that the central banks were selling their gold to raise cash because they had so many social programs that they had to pay for, such a huge debts that they have. So because of that, that's why needing cash is one avenue, again, that it forces you to sell. Tax considerations could also play a role. For instance, whether you've had a large capital gains, it's Christmas time or it's close, it's December, you feel maybe this is a good time, or you have capital losses, you feel you've had a lot of gains, this is a good time to get out of your investment. So this becomes more of a tax reasons. Or you could also do some kind of a tax management, in a sense that you feel that your income probably will be the higher or lower, so you can push, or if it's going to be much higher next year, then maybe you sell your capital gains, before end of the year. So these are the things actually companies do a lot with the, mutual funds and hedge funds. They take the tax consideration into the picture. Other things that I look at for the selling discipline, I look at what are the insiders doing. So I don't, I've mentioned it before, buying is more important to me than selling, especially cluster buying, when there's a few members of the board are getting, or the management, they're actually getting into purchasing it. Insiders activity are not as important because, again, you know, people have children to send to college, they have new purchases, they have to pay the mortgages or whatever it needed. So basically they do sell. What gives me the flag is when I see there's a cluster selling, when I see, all right, I can see the CEO needs it, but does the CFO and the president and the investor relations and the directors all at the same time, they see the same thing, they all have the kids in college? So that gives me, again, indication that there's something going on. So I look at the clusters. Also, the institutional selling, we've talked about, let's say, gurufocus.com. It's a great site. Then some of the institutions, some of the hedge fund managers you respect, you follow, you notice they've been lightening on their holdings, mutual fund managers. So that question, so that's also something you should follow, see why they are, selling. So you want to do more investigation. The other thing is, usually happens end of the year, beginning of the year, is the rebalancing. Let's say some of your investments, whether it's in the sectors or the purely stocks or any type of, again, the vehicle, they're becoming more concentrated. So if you started your portfolio consist of, let's say, Apple was like 20%, I'm just using that as, or 10% of your portfolio, all of a sudden it's grown so much, it's becoming 50, 60% of your portfolio. Maybe that would be some time to lighten up. It could also be asset classes. If you have, let's say, precious metals and you have growth stocks and you have technology, which is like a technology, and yet you have some defensive stocks and now, or value or growth, you want to make sure you keep that balance. Again, these are the things that a lot of big fund managers do. So that's about the money management side of things. The fourth criteria is the sentiment analysis. Basically, what is the psychology of investors as a whole? As you know, I go back to rubber band. We are all either really positive when everybody's positive. Maybe there's not many more people left to sell to. When everybody's negative, there's nobody really to, buy, in a sense that this is everybody's that's been selling. So is this a good time to get in because of there's just so much negativity? And that's more of like a herd mentality. So sentiment analysis, especially, I mentioned most of your investments follow the macro big picture. So indexes really they dictate the direction of your, the same, this case, stocks, and consequently your let's say options. So what you need to do, you want to understand what is the attitude of the whole investment world. So I mentioned again, 90 to 95% of stocks follow the indexes to the downside, and that's why we want to protect ourselves. So some of the criteria it's used is a put call volume ratio. You want to look at the extremes, the volatility index, which is VIX. We look at the market breadth, which is the advancing versus declining. Do we have healthy advancing stocks, or just only a few? I use the S&P's 200-day moving average to see what percentage of the S&P 500 they're above their 200-day moving average and what percentage are the below. So when it's like really, really low, let's say some 10%, which happened in March, was actually at 5%. Well, that means there's just so much negativity. This rubber band has really stretched. So that was a good time actually to start accumulating. When it goes above 80, 85, and we've really getting stretched, go to the 90, that means all the stocks are really pushing too high, and maybe it's time to lighten up. Commitment of the traders, we use it in the futures. We look at the, 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 the commercials, which they actually hold the commodity. Then you have the large players, large speculators, and you have the small retail speculators. We look at what are they doing and what is happening with, let's say, the retail investors. We look at ticks, which is the New York Stock Exchange. Every stock that goes up with the smallest, let's say it's 1 penny, it goes up, that's one tick. We look at cumulatively how the market is it healthy? Is everybody's going up together? And then we look at during the day, is this extreme? If having too much optimism, and that is, again, you have tools to do analysis. Then you look at some other things like at AAII, which is the American Association of Individual Investors, their sentiment. We want to see how many of them are bullish, how many of them are neutral, how many of them are bearish. Again, we look at the extremes. The CNN Fear and Greed, we look at the 7 factors, we see how much euphoria or how much fear there is. McClellan oscillator looks at the advanced declining base and the advancing volume, advancing declining. Again, you look at the extremes. Citigroup's panic euphoria model, that's also, again, you want to see, if you notice, I go this over this on our weekly market analysis, you see a few weeks ago, right, end of August, we had this big euphoria, and that's what happened. We look at the high and low of New York Stock Exchange. We look at the New York NYSE bullish percentage. You can find these, and again, in many services offer this. I find some of these, I obviously, a lot of these are in stockcharts.com, which is, pretty valuable free site. On top of all these, there's the stock market anomalies. These are the things they really don't have a lot of foundations, but it's interesting. So it's a good for storytelling. Some of them work. For instance, you got the calendar effect, which is we look at what is the best time of the best days. For instance, we look at like a Friday weekend effect. I have it. Fridays, a lot of time people are more positive, and look at things. And Mondays are really Monday effect, as people have gotten all the news, they overreact. So as you know, most of you, I don't like the trading on Mondays. I really hate it. There's a January barometer. It used to be big, or January effect. January effect was about mostly small caps. What happens is basically after the Christmas, when the first 2 weeks come, usually you have the first week of January, usually markets go up. January barometer is where January goes, the year goes. So if you have a up nice, especially from the previous year, you have a nice January, that's how the year will end. Sell in May, go away, till October, for instance. It hasn't worked in the last 10, 12 years, but the idea was, you actually lighten up in May and you wait till October, end of October, and then November you start buying. And what happens is, the reason was, and it was mostly because of the farmers. Farmers used to do the planting. So they didn't have any liquidity in May, so there was not a lot of activity. They would borrow from the banks. And then October will come, it's harvest season, the money is coming in, and basically they could pay their debts. The banks were getting all this money, and they were using that money to invest. So that's how the idea started, basically. So the Mark Twain effect, Mark Twain said that, the worst month to sell, I mean, the worst month to own stocks is October, right next to November, December, January, July. I mean, it's a joke, but that's what he said. This October effect, but yet he said 11 months are same. Turn of the month effect, for instance, we have this usually the last day of the month and the first day of the month, the markets go up because of the effect of the rebalancing, especially quarterly. Window dressing, the markets, the portfolio managers want to get their bonuses. They want to, keep show to their clients that they did really good. And then the first of the month is usually because the 401k money is coming in, or retirement money, and they go to the market. So these are, again, anomalies. On top of that, we've talked about the small stocks effect. Some of you have heard of the, NFC versus AFC, which is the old American Football Conference. When NFC wins, for instance, the markets are up. When AFC, the old American, wins, 85% of the time it's down. So, but there's no logic behind it. That's why it's called anomaly. So, but I just thought to throw it in there. This is interesting that I found out. Ned Davis, which has a great research, he went back to 1896, and he found out the best performing years ended in fives, from 1915 all the way to, we go to 2005, 2015. And they averaged about 26.3%. But the years that ended in zero, they actually we had a loss of 6.6%. So it is the only year with a negative median 2 years. And then also the ending at 7, we had a 1.1% decline. So we are in one of those years, so we'll see what happens by end of the year. But I thought that was interesting. I don't know if it's an anomaly, but he's done the research. So So let me finish it up kind of with my 7 rules of exiting, how I look at my selling rules. So the first one is I look at the technical analysis. So you go back and look at all the criteria I mentioned about moving averages, trend lines, support. Every one of them, I like to have 2 bars confirmation. And what I mean by that, 1 bar doesn't mean anything. So if you have a breakout, breakdown, we I like to see whether you look at daily, weekly, monthly, 60 minutes, 5 minutes. I need that confirmation to know that this is the time for me to get out. So usually once I get the 2 bars, the third day or the third period, then I will make a decision. Since we're talking about selling, then I'm out of it till I get the confirmation to get back in. My second rule is the profit targets. I always, always, always have my pre-planned profit targets. Since we do a lot of options, I do a lot of options. I make sure I have multiple contracts. I don't like to have one contract unless it's like real the funds, the capital is real low, then that's fine. With one contract, it just doesn't give you the same thing with futures. It just doesn't give you the flexibility to manage your trade. If you have one, then just look at it as, will you be happy taking 25%? You want to have 50, or will you be happy to lose 100% of your money? So basically just look at it that way. But with mine, I'd like to have at least in the 4, 6, the numbers that could be break down to quarters. I like to take 1/4 of my position. I always have the 25% criteria. I have 50%, 100%. And I usually like to have 1/4, at least one position as a runner with trailing stops that I use. And I think I've shared with you about the silver one that I shared with you. It's either percentage or the dollar amount that I'll be happy to be out. So make sure that that's definitely is the criteria is written in your trading journal so you know when to get out. So you put these targets as soon as you get out, because you will forget, you become discretionary, you would say, well, I will do it tomorrow, then you start second guessing yourself. So let's do it as soon as possible. And then for profit targets, especially on the stocks, I use good till canceled plus, which is after hours. Again, the reason for being is, again, this is not for my stop losses. This is only for my profit targets, because anomalies, we just talked about, happen after hours. Crazy things happen. The vaccine, somebody found a cure. There's just so much euphoria. They come in and the stock goes up $80. And after that, the news comes out, it was like the phase 2, or, FDA is going to look into it. All of a sudden it fizzles, and next day actually it's down. So I like to use some of these, again, like a news driven, and I've had some really good bonuses because of that. So that's another thing I would recommend for you to do. Use that again only in selling, because the things for selling for profit, not stop loss. I also use Fibonacci. You can use this a lot with the forex. So, but also it's been very profitable with even with some of these wildly moving uh, technology stocks and growth stocks. So for us, the sell zone, especially in the futures and indexes, is the 50 to 61.8%. We call that ambush zone. Usually when the market goes around that area, it reverses. So if it was going up around that time, there's usually resistance. So I usually like to take some profits at least. Now, if it continues, goes above that 61.8, it usually would continue to 78.2 and then to 100. But if it doesn't, turns around, it will drop pretty fast. So if it goes below 50, I'm out. So that's one idea. But also, if you want to have a target, you can actually even use Fibonacci extensions. You could use one, there's a 123, but mainly it's 138.2 and 161.8. And if you don't think these happen, just watch Teslas and Amazons and Netflix of the world, Nvidias, how easily they reach these. So you could use these as a profit target. The fifth criteria I use is in the futures market, but it could be applied in the stocks. I call it a 30-minute rule, but really it's a time exit. Now, when I get into, let's say, my futures, I'm looking at like S&P E-mini futures. If for like 30 minutes nothing happened, which was really flat, I'm gonna move on. I'm gonna go to something else. You could do the same thing with stocks. There have been times that people, especially we talked about squeeze, and things can stay in squeeze for a long time. And like there's no volatility. People use like weekly, and then you have done all your studies. It's a value investments. You love the company, but for years it doesn't move. So you have to really think: do I want to tie in my capital into this, or I will watch it, I will free my capital, and that's why these breakouts come. So when you have these really narrow channels for the longest time, you just wait for that breakout, and usually there's just so much energy that it will continue. You could use Bollinger Bands, but I use that time exit. That means I'm pretty impatient when it comes to things that they're not doing what they're supposed to do. So even if it's a little loss, it goes on, I'm out of it because I like to go and jump on something which is going to move. As far as the stop losses, on my options, I have a 50% stop loss. For stocks, I usually have 8 to 10%, and I'm out. I also use the moving averages, checks, or Bollinger Bands, but these are the pure numbers that I use if I manage it from the money manager point of view. When I play gold futures, which I have special strategies, let's say it's like 8 p.m. at night, West Coast time, Pacific time, it, per contract, if I'm down $300, I'm out. For index futures, my stop loss is $100. So that means like 20 points if I'm using Russell 2000, which is RTYs, and each point is $5. Dow Jones futures is each point is $5. So if it goes down 20 points, I'm out of it. For E-mini um, S&P, each point is $50. So if I'm down more than 2 points, let's say two and a quarter, then I'm out. So those are my criteria for exiting. I also, as you've noticed, my Bollinger Bands and Keltner Bands are very important. So when they go below that, because we talked about the squeeze, and the momentum starts turning down and stochastic is down, then basically what happens is that's my exit as well. And basically, I like to again follow that rule, make sure that everything is follows that criteria. So again, these are the emphasis, five, the stop losses, and Bollinger Bands. Just the last two things I want to share with you, just visually what happened in March. If you recall, in that February, we have in this situation, we have this is a Bollinger Band examples for the S&P 500. And then we have it when it happened in February. As you can see, this is Keltner channel. This is the Bollinger Band. We were in squeeze, and then the Bollinger Band actually came out. Bollinger Band started expanding. So I talked about the 2-bar confirmation. So I want to share that with you. This is at this time, you can see these 2 bars went outside the Bollinger Bands. And that was my selling criteria. We tried to get back in, but basically it was rejected, and then the rest is history. So as you can see, the momentum turned down, and that was the reason. Again, we went to the sell mode, and then around here when we started going positive, that's where you could see the turning on the Bollinger Band. We started getting positive and buying it. The last that I like to share, this is on IWM, which is a Russell 2000 ETF. These are the Ichimoku clouds. Again, I want to emphasize the 2 bars. You can see there was this 1 bar, almost like a doji, and this is the 2nd bar. So right around here, that was confirmation that it's time to get out of this. This is we call this turning line. This purple is the standard line. This is at the 9 and 26. They're not moving averages. The Ichimoku is a little different. We had broken down below both of them. So these are the things that you can follow again on your own, and just the confirmations to hopefully help you to avoid bigger losses. There is no bigger sin that letting your profits to turn into loss, and then your losses become much bigger loss. It's all about your loss control. So the last words I have for you is, number one, don't ever have any regrets when you are out of your position. If you have 8%, you followed your rules and you had 10% loss, you're out of it, and the market comes back and it goes up 20% or whatever. Well, it's a new strategy. So you can see the strength and maybe you can get back in. So don't ever have regrets, because 9 out of 10, you did make the right decisions and you protected your capital. 1 out of 10, it went against you, then you can get back on the bus and you can continue. The second rule is, it's very important. When we have a losing trade or investments, it is a business. It has nothing to do with you as a person. So don't ever equate losing trade or investments with being a loser. Emotionally, just separate those. This is a business, and please, again, make sure you understand this, because it is so important, because we start criticizing ourselves why we made this mistake, why we didn't pay attention. Well, we learn from it, and that's what you have to have your journal and write it down. So with that in mind, I really appreciate your time. Sean, thank you very much. Let's stop the recording so we can go if there's any questions.